This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. Well, one final step, of course, is that although we're going to receive that profit, it is in dollars and we're in the UK, and so we will need to convert it. And what rate are we going to convert at? Well, the profit is calculated on the day we finish the deal, which is 12th of November. And so, if we get the profit on 12th of November, surely we'll convert at spot on the 12th of November. And therefore, the pound profit, 6093.75, divided by 1.519 to convert, it's 4,012. And again, it's a receipt because we made a profit. And so what's the overall effect? The net, the total figure, it is two separate transactions, appreciate, two separate deals, but in total we end up with 789,993 plus 4012. The total, 794,005. Well, there we are. I mean, there's the futures deal we set up on the 10th of September. Again, at that stage, apart from paying a deposit, no cash changed hands. It's on the 12th of November everything happens. And let's look at what's happened. First of all, the transaction. Our reference point, at today's spot, we'd have got 794,176. Here, the exchange rate moved against us, and we only got 789,993. However, to compensate for that loss, effectively, that we've made, we made a profit on futures of 4,012, and the end result, we ended up with 794,005. Now, it's not exactly the same as our reference point, but you can see what's happened. We lost on the transaction, but we gained on the futures. In a perfect world, they would exactly cancel out. I said earlier, it's not perfect for two reasons. I'll write them down again in a moment. But we have, to a large extent, obviously, cancelled out that loss. We've used one risk to hedge against another risk. Now, as I said, it's not a perfect hedge. And there are two reasons. Now, I mentioned why it wouldn't be perfect in the last lecture, but check here. One reason, of course, is that we were stuck with fixed size contracts. In a perfect world, since we were at risk on, where were we, $1.2 million, in a perfect world, we'd want to have a futures deal on $1.2 million. But because of contract size, well, as I say, to be perfect, it should have been 12.76. It wasn't allowed. We've dealt in slightly more futures. And of course, I hope you would agree, if the futures deal is not the same amount, then it won't match perfectly. So that's one problem. We were limited by contract size. And in fact, we did know from the very beginning. And although you wouldn't be expected to in the exam, you could have said from the very beginning, there's a bit out of balance. You know, you could have calculated how much out of balance, $10,000 or whatever. And you could have perhaps done a forward rate or something on it. But the point is, you knew from the very beginning how much of a problem that was going to be. The other problem, though, rather more important, is even if we had been able to deal exactly 1.2 million, the other reason is, although futures prices do go up and down as spot rate goes up and down, the change in the two is not the same. That the change in the futures price is not equal to the change in the spot rate. Just check, it won't take a moment. But you see, the futures price, we already know. It changed from 5045 to 5120, and so the futures price changed by 0.0075. But what about the spot rate? Look back at the question rather than me winding up and down the screen. The spot rate, it ended up at 1.5190. As of September, it was 1.5110. And so it changed by what? 0.0080. And to be a perfect hedge, they would have to change by exactly the same amount. They won't change in real life by exactly the same amount. And so, although there will be this profit to cancel the loss sort of thing, it won't match exactly. You won't end up with a perfect hedge. Now, while I am there, one other thing which could be asked, it hasn't been asked in fact for a long time, and it's probably less likely, but it's very easy. Certainly in the past, you have been asked to calculate effectively how perfect a hedge it was. It's something we call the hedging efficiency. And I have in fact written about it further in the notes. If you turn to page 107, you'll see a note about it at the bottom of the page, which I'm about to explain. But if you go straight to page 108, example 12, I'll come back to the others later, but example 12 says calculate the hedging efficiency. And the hedging efficiency, to see how well they match, we take, now it looks a bit strange this, let me write it and then explain what I mean. It's the profit on one deal as a percentage of the loss on the other deal. Now, I can't think of a better way of writing it. What I mean is this: if you look back at our example, in our illustration, the exchange rate moved against us, and on the transaction itself, we lost money. Remember, at today's rate, we'd have got 794,000. We ended up only getting 789, so we lost money on the transaction. But to compensate, we made a profit on the futures. But it should be clear to you that if the exchange rate had moved the other way, if the exchange rate had moved in our favour, and it's, instead of going up to 1.519, if it had gone down to 1.50 or something, then we'd have ended up making a profit on the transaction. We'd have received more, but we'd have made a compensating loss on the futures. So depending on which way the exchange rate moves, one of the two will give a profit, one of the two will effectively give a loss. Well, the efficiency is always the profit, whichever it was where we made the gain, divided by the loss. Well, here it was the futures that made the profit, 4012. It was on the transaction that we lost money, and how much did we effectively lose? Well, remember, at today's rate, it would have been 794,176. we actually ended up getting only 789,993. And so we effectively lost the difference. Of 4183. Well, the hedging efficiency is simply the profit as a percent of the loss. So in this example, check me, but I get to the nearest percent, I get 96%. Now, I said earlier, it is actually unlikely you'd ask for this. But I mention it because it has been asked, certainly in the past. We're very clear about one thing. First of all, if you got an efficiency of 100%, I hope clearly, 100%, it would mean the profit exactly equal the loss. You'd have a perfect hedge. Well, we already discussed why in real life it's so unlikely to end up being a perfect hedge. In ours it wasn't. The efficiency was 96%. But be clear that if it's less than 100%, as it is here, it means the profit was a bit less than the loss, and so we've made an overall loss. Again, you see at today's rate you'd have got 794,176. We only got a total of 794,005. So although we cancelled most of the loss, there was still an overall loss remaining. Equally though, you can end up with hedging efficiency of more than 100%. You know, if you did ask it and you did get more than 100%, don't worry. In the past, people have worried they must have made an error, but no. It is possible, mainly because of this contract size limitation. It is possible that you end up with a profit bigger than the loss, but again, they don't match completely. If it was more than 100%, you'd have ended up with an overall gain. So, a small point. It's the main example that's much more important. But I mention it just in case it happens to be asked again. All right, one last thing for this lecture. I've said several times that we do have an efficient futures market, and that certainly in real life, as the spot rate moves up and down, the futures price, they'll go up and down as well, but the movement isn't precisely the same. In the example we just did, we were actually told the spot and the futures price on the date of the transaction, but in fact, we are able, and you could be expected, to estimate what the futures price would be. Let me explain what I mean, again by example. This is estimating the futures price. And to show you how we do it, can you look at example 10? On page 106. And it's just a little extract here, and when we've done it, then you can have a go at a full example with everything in. Example 10, it says on the 1st of July, we're given the spot rate, 1.5050 to 1.5150. We're also told what the price of September futures is on the 1st of July, it's 1.49. It then says, on the 31st of August, the spot has changed. The spot rate's gone up to 1.525 to 1.537. And it asks us to estimate what the futures price would be on the same day, on the 31st of August? Well, let's do it. I always set this up as a little table, but how you set it out's up to you. But let's first of all write down what are the spot and the futures price today. Today, the 1st of July. Well, the September futures. The price of the September futures is 1.4900. And we're going to compare it with the spot rate. Well, fine, except of course there is that spread, and we can't really compare it with two different rates. And so what we'll do is we'll take what we call the mid-market spot, which is simply the average. That the spot rate it's 5050 to 1.5150. Well, let's work out the average. Add them up and divide by 2. It's the mid-market spot. Well, it comes to 1.5100. And of course, the two are different. They are different things. And what is the difference? The difference is 0.02. If you want, put a bracket round it for what's coming. It doesn't really matter, but the difference is 0.02. Well, we want to estimate the futures price on 31st of August, which in a full example would be the date of the transaction, because that's when we'll finish our deal. 31st of August. Well, we know what the spot rate is on 31st of August. And again, I'll use the mid-market, the average. The average, it's 1.5250 to 1.5370, which gives me what? Sorry, my calculator went wrong. 5250. 1.5370. The average 1.5310. So we know the spot, but our problem is we want to estimate what the futures price is going to be. Well, we make one assumption. We assume that the difference between them, which remember at the moment is 0.02, we assume the difference falls linearly to 0 over the life of the future. Now, what do I mean by that? First of all, the life of the future. When does this future end? Now, if you think back to what I've said earlier, a September future, you can stop the deal any time up to the end of the relevant month, the end of September. And so, since we're dealing in September futures, the end of the future, which I think is a lovely expression, the end of the future, is the last day of September, 30th of September. And we say, okay, on the last day of that future, whatever the spot happens to be, and the futures price happens to be, the difference will be 0. And that is sensible if you think about it. On the very last minute sort of thing of the future, you would expect the futures price and the spot rate to be the same. They must be. Well, at the moment the difference is 0.02, 1st of July. By the end of the future, by the 30th of September, the difference will be 0. We assume that the difference falls linearly over that period. So let's work it out. At the moment, how many months are there to go? Beginning of July to end of September, July, August, September, there's 3 months. We want to know what the difference will be at the end of August. Well, by the time we get to the end of August, at that stage, there's only 1 month to go. And so if the difference is falling linearly, surely the 0.02, it'll have dropped by 2/3. There'll simply be 1/3 remaining. And so with 1 month left to go, the difference, 1 month out of 3, it'll be 1/3 of 0.02, which is how much? 0.0067. And of course now we can estimate the futures price. At the moment the futures was 0.02 below the spot. Well, on the 31st of August, on our assumption, it'll be 0.0067 below the spot. Which I get to be 1.5243. There is our estimate of the futures price on the 31st of August. Now, it is an assumption. The fact it'll end up being 0, that is a fact. It's not worth wasting time on, but in real life, the difference must be 0 on the last day. There's no reason at all why the difference should fall linearly. You'll expect it to fall, certainly, but there's no reason it should be a linear fall. But certainly in the exam, if you're ever required to estimate a futures price, you will make that assumption that it falls linearly. Here, conveniently, my dates were beginnings, ends of months. I counted months as 1 month left out of 3. Quite likely, if it's relevant in the exam, today might be the 10th of July. The date of the transaction might be the 15th of August. Well, if it's not beginnings and ends of months, he would expect you to count days and do the same sort of fraction, the same sort of apportioning, but doing it in days instead of months. However, there we are. And very likely is that you'll have the two things together. What I mean is, the main example we did, we set up the futures deal. On some occasions, that's all that's been required. That's been marked all on its own. We then saw what happened on the date of the transaction, and we were given spot, and we were given a futures price. And in the exam, if you're given spot, if you're given the futures price, you obviously use them. What's quite likely, though, is to give you the same sort of example, but on the date of the transaction, to give you spot, but not to give you a futures price and expect you to estimate. So if you're given a futures price, use it. If you're not, then you estimate it in the way that I've just shown you with example 10. Well, now really it's your turn. It really is worthwhile having a go. I mean, look back, obviously, at this lecture again if any of it was too fast or you're not clear. If you are clear, it really is worth having a go at example 11, where in example 11, again, same sort of thing, but it'll be a question of setting up the futures deal, which futures are we dealing with, how many contracts, and so on. Then showing what happens on the date of the transaction. But you will have the one extra bit here, that on the date of the transaction, you're given the spot rate, but you're going to have to estimate the futures price. So you have a go at example 11. In the next lecture, I'll work through example 11 and then make a couple of final points to do with futures.